Hello everyone, welcome to you on Think Future Academy channel. Today we will cover the business applications uses different types of system like financial accounting, cost accounting, budgeting system and cost of capital. Let's start with financial business applications. There are some of the financial business applications that are used by organizations to manage their financial activities and information. Financial accounting. Financial accounting. This is a type of application that records and reports the financial transactions and performance of a business entity, such as revenues, expenses, assets, liabilities, and equity. Financial accounting follows generally accepted accounting principles, GAAP, and produces financial statements, such as income statement, balance sheet, and cash flow statement, for external users, such as investors, creditors, regulators, and tax authorities. Cost accounting. This is a type of application that tracks and analyzes the costs incurred by a business entity in producing goods or services. Cost accounting helps to measure the efficiency and profitability of various business activities, such as products, processes, departments, or projects. Cost accounting also helps to plan and control budgets, allocate resources, and optimize pricing strategies. Budgeting system. These are applications that help a business entity to plan and monitor its income and expenditures for a specific period of time. Budgeting systems help to set financial goals and targets, allocate funds to different activities or departments, compare actual results with planned results, and identify and resolve variances or deviations. Cost of capital. This is a concept that represents the minimum rate of return or profit that a business entity must earn before generating value for its investors. Cost of capital is calculated by considering the cost of both equity and debt capital used to finance a project or an investment. Cost of capital helps to evaluate the feasibility and profitability of different projects or investments, and to determine the optimal capital structure for a business entity. Others are occasionally used to value assets that are being purchased or sold. Now we will understand each application. Let's start with financial accounting. One of the primary goals of financial accounting is to determine the business's periodic income. The cost of products sold is a significant component of the income statement in manufacturing enterprises, COGS. COGS is the portion of inventory cost that can be deemed a period expense since the products were sold. It is recorded as an expense on the company's income statement. Depreciation is another expenditure that appears on the income statement as a recurring item. Every asset is originally evaluated at its purchase price. Accountants charge the asset's cost to depreciation expenditure throughout the asset's useful life. This cost allocation method aims to align costs with revenues and is more dependable than attempting to estimate the asset's fair market value on a regular basis. Important note: costs are assets rather than expenses in financial accounting. Expenses become costs only when they are deducted from current income. Expenses can be allocated as costs against income over time, such as depreciation, or they can be charged as expenses as revenues are earned, such as COGS. Cost accounting. Cost accounting, often known as management accounting, offers accurate cost data for budgeting and management decision-making. Cost accounting tracks and determines expenses connected with various company tasks using standard accounting concepts. Management uses this information to enhance operations and make them more efficient, economical, and lucrative. To record the expenses of manufactured goods, two primary techniques are available. These are referred to as task costing and process costing, respectively. A job cost system, also known as a job order cost system, gathers costs for each physically recognizable job or batch of work as it passes through the production plant, paying little attention to the accounting period in which the work is completed. A process cost system, on the other hand, collects costs for all goods worked on within a certain accounting period. The total expenses are then divided by the number of units worked on during the time to determine unit costs. Process cost systems are best suited for continuous operations, where similar items are manufactured, or when many departments collaborate and participate in one or more activities. Job costing, on the other hand, is utilized when labor is the most expensive component of the cost, when a variety of lines or goods are made, or when items are built to client requirements. Cost standards are frequently produced when costs are clearly visible and quantifiable. They are also known as design standards since they are produced for each physical input at each stage of the manufacturing process. The engineered cost per unit of production may then be computed. A cost accounting system can provide management with the accountability and cost controls it needs to optimize operations by recording variable costs and properly assigning fixed expenses to different departments. Budgeting systems. Budgeting methods rely on cost accounting systems that are accurate. Budgets for each department at various levels of production may be established using cost data obtained by the business's cost accounting system. Cost centers, profit centers, and departments can be assigned to various business units. Budgets are then utilized as a management tool, among other things, to monitor performance. The extent to which actual data differ from planned amounts is used to assess performance. When considering budgets as performance indicators, it is critical to distinguish between controlled and uncontrollable expenditures. Management should not be held responsible for costs over which they have no control. Fixed costs are seldom controllable in the near run. As a result, a typical budget statement will indicate forecasted sales income as well as the variable expenses associated with that level of output. The contribution margin is the difference between sales revenue and variable costs. Fixed costs are then subtracted from the contribution margin to calculate operational income. Managers and departments are then assessed based on expenses and the production factors they are supposed to control. Cost of capital. Estimates of a company's cost of capital are required for capital planning and other business choices such as lease-buy decisions, bond refunding, and working capital policies. Capital budgeting considerations center on whether or not to acquire a certain capital asset. These judgments are based on a cost-benefit analysis, which is an assessment of the net present value of future revenues provided by a certain capital asset. The company's cost of capital is an essential consideration in such selections. The cost of capital is a percentage that shows the interest rate paid by the firm for the money raised. Each component of capital, debt, equity, and retained earnings, has its own cost. The cost of each form of loan or equity is also varied. While a single kind of capital may be used to support a specific purchase or project, businesses are more likely to employ a weighted average cost of capital when making financial choices. This method considers the fact that the firm is a continuing concern that will need to obtain capital at different rates in the future as well as at the current rate. Other applications. Expenses are occasionally used to value assets that are being purchased or sold. Buyers and sellers may agree that the value of an asset may be established by assessing the expenses of building or producing an asset that performs comparable duties and provides similar benefits as the present asset. The cost method to asset valuation differs from the income approach, which seeks to determine the current value of the revenues the asset is projected to generate. Ultimately, price decisions are based on expenses. The ratio between prices and costs is referred to as the markup by manufacturing businesses, and it shows the difference between the selling price and the direct cost of the items being sold. The gross margin for retailers and wholesalers is the difference between their invoice cost and their selling price. While expenses are a starting point for pricing decisions, market circumstances and other considerations generally determine the most profitable price.
I hope you enjoyed this video, and before leaving, if you have not already subscribed this channel, make sure to subscribe, like and hit the bell icon to get updates when I post new videos. Provide your feedback in comments. You can download material from the below links under video.